Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Hello all there, and welcome inside of the Steno Research headquarters. My name is Mikkel Rosenvold, and I'm your host today. I'm alone in the studio today because you, Andreas, have caught a bit of a sniffle. How are you doing, Andreas?
Well, it's not just a flu; it's a man flu, Mikkel. So I guess that's quite telling. Yeah.
Very serious. It's been a couple of hectic weeks, Andreas. So it's all fine. I mean, what a reaction we had to the election last week. We're not going to delve too much into the election result. I think people have chewed on that a whole lot, but let's just dive a little bit into some of the developments and judge whether it's already perhaps too late to be in the Trump trade, Andreas. Let's perhaps start with Tesla. We talked about this before the election, Andreas. What a development. What's the roof here? I just want to start by this. Is it too late to go into the Trump trade on Tesla, for instance?
Who knows? I tweeted on, was it on Friday, after Elon attended a call with the Ukrainian President Zelensky together with Donald Trump, that no one had enough Tesla or Dogecoin in their portfolios right now. And I think it's quite telling what we've seen in the market since the election result became known. Everything related to the loyalists surrounding the administration has been through the roof in markets. And Elon is obviously almost, he's got his face sort of tattooed to this administration in many ways. Peter Thiel to some extent as well with Palantir. And yeah, it's just been a hell of a ride. I think there's more left in the trade, to be honest. I don't think you should underestimate the amount of power that Elon's got in this administration.
Absolutely.
I think he wants something in return.
Absolutely. Andreas, I have to admit, I wasn't looking at Dogecoin at all until I think what was it, the week before last. We had the monthly call with Raoul, and he pointed out Dogecoin as a potential Trump trade after the election. And my God, he was right. No one had enough Dogecoin. Do you think it's real? Is there some foundation to this? Do you think Dogecoin could be used for some purpose within the government, or is it simply the Elon trade here?
I think it's an Elon trade. I'm not a subject matter expert on Doge, but to me, it's still labeled as a meme coin. And from a fundamental perspective, I probably like Solana, Ethereum more than this. But it's hard to bet against this currently, and it's not like we've seen a major move in the context of moves seen earlier in Dogecoin. So to me, it's hard to bet against this just because Elon is so powerful within this administration. But obviously we've seen new all-time highs in Bitcoin as well. We're starting to see a large move in Ethereum. Ethereum is in our portfolio right now. So we've thankfully gathered some very, very good returns on the back of this. But sorry, we're kind of sorry that we didn't have Dogecoin in the portfolio.
Yeah, sure.
That's what it is.
Anyway, Andreas, we're going to talk a little bit more about the upcoming Trump administration a little later. Perhaps the lookout for the Ukraine war, which is looking incredibly interesting to me. But obviously as well today, Andreas, you have the eye on what everyone else is missing in global macro space. We're going to talk even more about liquidity, even though it's being overshadowed by political events in the US and Germany right now. So we'll get back to that in a little while. But before that, Andreas, I just want you are in contact with many of our hedge fund clients here at Steno Research. What was your vibe when discussing the election with them late last week? Was this as they expected? Were they happy? What's the vibe you were getting?
So in many ways, Trump was the base case, and I still firmly hold that view that a lot of people had positioned for this, especially in bonds and in the dollar. If you look at the moves in fixed income space ahead of the election, we saw the typical Trump trade roaring, right, with inflation expectations up, bond yields up, the dollar up. But we kind of have a lagged effect now in Dogecoin, Tesla, some of these Elon bets, but the average hedge fund out there clearly had Trump as the base case ahead of the election, trusted the prediction market a lot more than the opinion polls, which proved to be a good idea.
Absolutely.
And therefore, I think the overwhelming conclusion is yes, the average hedge fund is happy about this result. I think the major pain trade right now, which by the way would be good news for crypto and other risky bets, is if bond yields start to drop. That's very related to the liquidity discussion as well, Mikkel, and the whole conundrum around sovereign bonds trading very weak, as we've seen over the past 2-3 months. And for now, it actually seems like this whole bond scare surrounding Trump's new administration is vanishing into thin air. I don't really see strong momentum behind higher bond yields right now, and I even think there are good reasons to expect that they will come lower into year end. And to me, that is the ultimate set of good news for those hoping for large returns in risk assets.
Absolutely. We'll get more into bonds in a little while, Andreas. I just want to talk a little bit about the Trump administration, because I think one thing that a lot of people, perhaps especially in Europe, are missing is that, in my view, this is a completely different Trump than 8 years ago. The Trump who took office back in 2016 was caught by surprise. I don't think he expected to win that election at all. He wasn't prepared in any way. He had no political experience. He had the team around him was your Steve Bannon, Roger Stone type of guys, and Anthony Scaramucci. I think this time around, it's a whole different setup. It's a whole different organization. He's chosen a very strong pick, Lars, for chief of staff. He comes in with a very, very strong preparedness. He's already lined up, which is by no means a quick decision to try and force through his appointments, even though Congress is in recess. He's trying to dominate the Republican Party within Congress. He very clearly has the mandate out of the election for that. So this to me signals a whole different Trump, and you should keep that in mind when trying to predict what he's going to do. I think Trump is going to be more predictable. It's going to be less of a Twitter presidency than last time around. How do you see this, Andreas? Do you think we can count more on what Trump will do now? Be more predictable? What's your expectations?
So remember, maybe 12 months into his first presidential term, we had a summer of massive turmoil in his administration. Anthony Scaramucci, as you mentioned, I think he had like 2 or 3 weeks as the communication officer of the White House. So it was very much in and out, that administration. I think we should expect the administration to be a lot more solid and stable this time around. He's built a team of loyalists. He's pretty much aware of the team he wants to set. And I think that's the overwhelming conclusion. And I even tend to think that Trump will be a much more benign president this time around, if you know what I mean. He's already started talking about unity after this very divided election. And maybe he will slowly but surely consider his legacy when taking decisions now. That's something we've seen from other presidents, right? If, I wouldn't rule out that Trump intends on being president for more than 4 years from now. But setting that bizarre scenario aside, it's very common that you use your last presidential term to make some deals that will secure a strong legacy, right? Maybe one of those deals could be surrounding peace in the Middle East or in Ukraine.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
Absolutely, Andreas. I just want to touch a little bit about on the Ukraine scenario, because obviously that's on top of our head here in Europe when we discuss this upcoming presidency. Trump famously pulled in Elon Musk, as you mentioned, Andreas, on a call with Ukrainian President Zelensky, which was somewhat of a surprising move. Of course, if you go back 18, 24 months, Trump promised that he could end this war within 24 hours. He chose a bit more of a patient approach with that. But it seems like he's got a plan. And to be honest, Andreas, this plan is very much what I discussed in a piece a couple of months ago. I called this I had two scenarios for how peace in Ukraine could come along, sort of an unresolved ceasefire, or what I called a bitter peace. And Trump's plan is very clearly in the bitter peace category. It essentially means, let me just draw up Trump's plan and compare it to this real quick. So Trump's plan is for a peace deal where Russia basically gets to keep the occupied territories, the Donbass, the Crimea, etc. You set up a demilitarized zone along the current front line, which is to be manned by European and British troops, not US troops. And then Ukraine doesn't get the rest, the western part of Ukraine, which remains independent, doesn't get to join NATO for another 20 years. The last part you could also interpret as Ukraine will join NATO in 20 years, but you sort of get a cool down period, which in the meantime, Ukraine will be guarded by Western troops, so they will essentially be some sort of NATO member. I think that's how Putin is going to view it, at least. But it will allow Putin to save face. I mean, he's not going to be around for 20 years, so he can say that at least in his lifetime, Ukraine isn't going to be a NATO member. I think this is a very clever plan, very much along what I call the bitter peace, because, and what's bitter about this, obviously, is for Ukraine to more or less legally accept the loss of some territory, essentially the territory to the east and south of the current front line. I think this is a great plan, to be honest. It's not too different to what the Chinese suggested a year ago. It's a little bit more benign to the Ukrainian side, and obviously there are going to be very, very tough negotiations. But there is a real momentum here, Andreas, and that's what's interesting. Trump has opened up a window for negotiations, for talks, which has been closed for 2 years. No European leader has been able to open this window. Now we'll see what Putin and the Ukrainians have in mind, and how this could affect markets as well. I think Europe has a very big dilemma on this, but it's obviously really a biggie to watch over the coming months. I think Trump will try and get a deal done before he's inaugurated. Very, very interesting. Obviously, of huge importance both for energy, grain, global markets in general. So, Andreas, one more point from Europe. Germany. We've talked a lot about Germany, not too much in the positive space. Now the German traffic light government has collapsed, essentially. The Bundeschancellor Olaf Scholz has sacked his finance minister, Lindner, who's obviously of the Liberal Democratic Party, essentially tearing apart his own coalition government. Essentially, Andreas, to put this very, very briefly for our US listeners, the government had run out of money to spend. Essentially, they had rammed their head into the German equivalent of the debt ceiling. Olaf Scholz wanted to reform the debt ceiling to allow the government to invest and spend more via raising debt. The Liberal Democratic Party wouldn't have this. So now we're looking ahead at the very latest, I think, snap elections in March, possibly even before that. Olaf Scholz is meeting the head of the opposition, Friedrich Merz, this week to discuss perhaps moving that election even further ahead. What do you see here for Germany? What should investors look out for in this scenario, Andreas?
So, if we turn back time half a year or so, we had the French snap elections after the European elections in Europe. And those snap elections swiftly turned into some sort of discussion on whether the ultimate result of the election could turn France to the right, basically. And when you look at opinion polling right now in Germany, we have the Alternative für Deutschland polling around 20%. They're probably not going to be big enough for them to gain any substantial power. But that's the kind of scenario that international investors typically dislike. And we saw it, around the French elections. Bonds sold off, equities sold off, and especially Asian flows were extremely negative. So I wouldn't rule out something similar. And that's probably the last thing that Germany needs right now is some sort of outflow scenario of global investors fleeing. But on the other hand, well, it's very hard to find something positive to say around the momentum in Germany right now.
Absolutely.
And I honestly think that the German DAX index is trading at very high levels relative to all of the uncertainty here, and we've got a lot of questions on that. And obviously, it's driven by, these are blue chip companies in the DAX index, right? They don't have Germany as their main market; they're just based out of Germany. So this is more a result of the global economy doing better. It's not really a result of the German economy doing well. And this happens at the same time as liquidity trends have turned extremely sour in the Eurozone. We've talked about liquidity in dollars for quite a while, but the situation is a lot more dire in euros. And for the first time in a long while, and potentially we're even writing history now, euro liquidity is more sought after in markets than dollar liquidity, and that's something. It's safe to say that it's extremely out of the ordinary, and something that puts a lot of pressure on the European Central Bank.
Absolutely, Andreas. Now, I'm a political analyst, Andreas. I get equities, I get commodities to some extent, I get FX, but on fixed income, I'm a complete noob. So Andreas, you wrote a great piece on this yesterday. I understood most of it, but Andreas, can you explain this to me like I'm Kamala Harris? Why does it matter that European liquidity could be more sought after than US dollar liquidity?
The issue is that the European Central Bank is doing so-called quantitative tightening, and they even intend on ramping up quantitative tightening by year-end in the so-called pandemic purchase program that they spend a lot of euros in during the pandemic. So what we have on the chart here is this sort of ratio between dollar liquidity and euro liquidity, and it's on the right-hand scale here. So a ratio of almost 2 means that we have twice the amount of dollars available than euros. And is that exceptional? Well, if you look back to 22, it was roughly equivalent sizes, right? So we had the same amount of dollars to euros in the financial system, and now we have twice as many dollars as euros in excess. I think there are two takeaways from this. Euro liquidity is getting very tight. It means that euro bonds will likely trade in an abysmal fashion due to this, also compared to interest rate expectations and all that. But it also means that dollar liquidity is, the development in dollar liquidity is much more benign than it is in euros. And I think what we see in Bitcoin, DOGE, Tesla, etc., reflects this. The next question, or the upcoming question for central banks, because it's not like dollar liquidity is super ample, but it's more ample than euros, is whether liquidity turns sufficiently tight for them to do something soon. And that's basically been our base case for a while, I'll say a couple of months. We've kind of agreed that this had to be a positive scenario for risk assets and crypto, etc., because it seems like the market is sort of sniffing out that liquidity is upcoming. But none of the central bank meetings last week really got any, they didn't deliver any like major signals on liquidity for the next month or two. But in any case, the point here is that liquidity in euros is exceptionally tight. Liquidity in dollars is less tight, but also tight. But it seems like we're slowly but surely getting to historical extremes meaning that liquidity will have to be added. That's kind of how I view it. And when you get to a situation where the so-called 5-year cross-currency basis trades at zero, as you have on the chart here between Ester and SOFR, it's a strong hint that liquidity will have to be added by the European Central Bank soon.
So why is the European Central Bank not reacting to this yet? Is it are they too hung up on the current political agenda? Is the timing not right? What do you think?
Well, the European Central Bank is a reactive central bank, and they prefer to see other central banks moving ahead. And I think you should look at the euro-dollar exchange rate right now to understand why. We're trading between 106 and 107 in euro-dollar. Low levels also in a historical context, and the trend is clearly towards parity now, rather than the opposite. Should the European Central Bank get a very weak currency, they could face an import inflation problem again. And if let's assume that they added a lot of liquidity here, basically printing new euros, it would likely weaken the euro even more than what we've already seen, right? So that would be my working thesis on why they're so slow. They'd like to see the Fed acting to ensure that the liquidity trends sort of match each other on both sides.
And so, Andreas, how does this affect the ability for European governments to move away from austerity? Because I think politically speaking, that's also what we're seeing in Germany and in France, other countries, that politically Europe is perhaps moving towards realizing that we need to make more public investments, like they're doing in China, like they're doing in the US. Shouldn't this make it harder for that to happen, or what do you expect?
Yeah, I think you have it on the next slide, Mikkel. So the issue for politicians right now is that sovereign bonds trade in an abysmal fashion. So this is the asset swapped Bund. So what does that mean? It's basically the spread between the Bund, the 10-year German official bond instrument, and the swap rate. So when there is a negative spread between the two, we have this spread just below zero. It basically means that, at least on the surface of it, bank credit risks are perceived to be smaller than sovereign credit risks. At least that's one way of explaining it. That is, again, exceptionally out of the ordinary, right? Why would a credit risk of a bank be smaller than the credit risk of a sovereign? I mean, typically a sovereign is the one aiding banks if beep hits the fan, right? And now we're kind of seeing the opposite. So to me, this is a strong hint that sovereign bond markets are not trading well. It's a strong hint that when central banks are not providing a bid for sovereign bond markets, politicians struggle to issue. And that's basically why I think some sort of light yield curve control is in the making, both in the US, but especially in Europe, because if you want to issue more, you simply need to control the cost of debt. You need to control how bond markets behave, and currently they're not behaving.
Interesting, Andreas. I just wanted to pull up one more chart before we round off and talk about our positioning. I wanted to pull up this chart, Andreas. This is our regime model for the Eurozone. Now, obviously, when we're talking about the prospect of added liquidity to the euro, that's a forecast, and this is a nowcast. So that's why the green line on liquidity is very, very low here, because right now, no new euros are flowing in. Growth is still looking relatively decent, and we're seeing some sort of uptick in inflation that I'm really curious about here, Andreas. Do you have any idea what's going on there? Are we actually seeing rising prices in Europe? How does that correspond with falling with the lower oil prices, etc.? What do you think is going on here?
Yeah, so if you look beneath the hood, we're talking about rising food prices again. We're also to some extent seeing a pressure in wages. And then expectations have been on the rise after the election, broadly speaking. And now I refer to the US election again. So this is in many ways a Trump effect in Europe as well. when you look beneath the hood of the growth component here, it's also visible that Germany is not the driver. We're talking about Spain, Italy, and countries like that actually performing better than Germany. So it is a very mixed picture we have in the Eurozone right now, and the momentum is much stronger in the southern parts of the Union rather than in the northern parts, which is completely upside down to what we've been used to.
Yeah, but we are getting used to that as the new scenario. That's where growth is coming from, is from the south and the east of Europe. At least we've got some medicine to sell here out of Denmark, so that's at least reassuring. Now, Andreas, I promised this was the last chart. I have one more. It's not a chart. It's a snapshot of an article you did. I just want to round off the China story that we've been tracking for a couple of weeks. This is not stimulus. It's a debt swap, which was pretty much what you anticipated, Andreas, that we were getting no new money, so to speak. We were only getting sort of debt being shuffled around the Chinese society. Is that too simple a way to describe this?
Yeah, we had the fiscal briefing on Friday morning, and the Chinese authorities actually labeled it a debt swap. I wrote this a few weeks ago in the weekly China Watch that we release, and finally, they actually admitted to it. I had accused them of hiring some sort of marketing agency calling this stimulus, because it's not. They're issuing new bonds, national sovereign bonds, and they allow regional governments to tap into those issued bonds in order for them to replace off-balance sheet debt with this new sovereign debt. So they're bringing off-balance sheet debt on balance sheet, and they'll probably get a marginally lower cost base out of this, the regional governments. But the point in case here is that they're just issuing a new debt instrument, spending that debt instrument on paying back another debt instrument. So it's not like they issue a new bond and then spend the money. They just pay back another creditor. And that is, in my view, not stimulus. Of course, it's on the margin good news that they bring off balance sheet debt on balance sheet. It makes it more transparent. It makes it a little bit cheaper. But the briefing on Friday was basically spot on in terms of sizes relative to the Reuters article we got out the week prior, meaning that we have 10 trillion yuan in total. And it basically means that they're dealing with 10% of the size of the issue here. So this is not the last time that they've held such a briefing. We'll get plenty of those in 25 again, and I'm not really an optimist that it alters the course in any way in China.
No. And this is usually the point where I would bring up some snippets from our PCA tool to show where our models show some value gaps. But I mean, right now, Andreas, some of the value gaps we're getting as feedback from our models, especially in equities, is not really something to trade after, because you have this whole election influencing thing, which our model obviously to some extent understands, but not fully understands, if you know what I mean.
It's a very idiosyncratic event in many ways, right? And the move in Tesla, the move in Bitcoin, it's not really explained by macro right now.
No,
it's much more of a momentum story after Trump won, but a very strong momentum case, and one that we've thankfully been partially involved in. Ultimately, what I'm trying to say here, it's not really a macro market right now. It may turn into a macro market when we get that liquidity addition, but in any case, it's time to turn upbeat. And when you look at the expected returns for equities in our models right now, we're talking plus 25%, which is historically very high.
Yeah. So what does the macro tactician do here, Andreas, for the next 1 to 2 weeks? Follow along the Trump train. Don't piss against the wind.
Yeah. Buy risk. Yeah.
All in on risk. All in on DOGE.
Yeah. Why not?
Especially, and then follow this program for knowing when to jump off the train in a couple of weeks, unless we get, as you labeled it last week, which a couple of our listeners really liked, until we get the biggest liquidity event since Noah. I like that framing very much, Andreas. Any last point on positioning, trade ideas?
No, everything that we'd hoped for, say 2-3 months back, is now slowly but surely coming into fruition. So this is a very benign scenario, and Trump has proven to be the catalyst for this risk-on move, and I think there's more to it.
Great stuff, Andreas. I think I'll let you off the hook for now. That's got us covered for this week at least. We'll be back next week with even more on global macro. Until then, thanks a lot for joining, Andreas, and thanks a lot to all of you out there for listening in. We'll be back next week.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.